Welcome back to Investing Talk Podcast.
Today we're looking at United Health Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. United Health Group, this is a textbook case of a company with amazing operational strength that just keeps running into external headwinds.
Right, the classic conflict. They have this, robust growth, but then they're always dealing with regulatory pressure and these rising medical costs.
Exactly. And the most recent story is really about a very sharp rebound from that kind of operational stress. It seems like they've managed to restore a lot of that broad market confidence.
Yeah, what's so fascinating is just how fast that narrative changed. Things looked pretty shaky earlier this year in the summer of 2025.
It really did.
But if we just look at the last 3 months, say August through October, what were the actual catalysts that got institutional investors to jump back in?
Well, it really started in August with a huge vote of confidence. After a pretty tough second quarter that scared off a lot of retail money, things started to stabilize.
And that's when the big money came in.
That's when it started. The most well-known example was Appaloosa Management, David Tepper. He dramatically increased his stake to, 2.45 million shares.
Okay, so that's a massive signal.
Yeah.
That's it. You have very high conviction the stock is way too cheap.
Precisely. And that he believes they can execute a turnaround even with those DOJ investigations into Medicare billing still, hanging over their heads.
Hold on, though. If those regulatory issues were still out there, why would a fund like Appaloosa go in so heavily before any good news was confirmed? Was that just a pure valuation bet?
It was absolutely a bet on valuation, but it was also, I think, underpinned by this belief that the regulatory risks were already priced in.
Oh, okay.
And that the underlying business, the cash-generating engine, was just too strong to be held down forever.
So that institutional conviction sort of paved the way for what we saw next?
It did. The momentum in September, when the stock jumped to over 9%, that surge was really fueled by a wave of bullish analyst upgrades. You had Bernstein, Barclays, all citing the strong fundamentals, especially in government-managed care.
And then the knockout punch, the Q3 2025 earnings report.
That was the decisive moment. That was the proof point everyone was waiting for.
So they didn't just meet estimates, they blew past them.
They decisively exceeded them. Revenue was robust, over $111.6 billion, but the most critical detail, the one that really lit a fire under the stock.
A guidance.
The guidance. Management upgraded their full year 2025 adjusted guidance to at least $16.25 a share.
And that signals confidence in accelerating growth in 2026.
Exactly. That's what did it. That restored broad investor confidence, and it sparked a rally, not just in this stock, but really across the entire healthcare sector.
It proved the core business was actually accelerating, even with all the pressure. Okay, so let's look past that rebound for a second and drill down into the foundation. Why do analysts always call this company a wide moat business? What makes them so resilient?
It's built on two pillars: scale and diversification. Let's just start with the financial foundation.
Okay.
The top-line performance is just relentless. Q3 revenue was $113.2 billion. That's up 12% year over year.
And that's coming from premium increases and just grabbing more market share in places like Medicare Advantage.
Right. And just as important, their balance sheet is built for stability. We're talking a very manageable debt-to-equity ratio of about 0.6.
That's low.
Very low. And they're generating something like $16 billion in annual operating cash flow.
$16 billion. That's staggering. That lets them absorb almost anything, invest, and keep paying dividends.
It makes them incredibly stable. But the competitive edge, your question about the moat, that's where it gets really interesting. It's not just about size.
So it's not just having a lot of members.
No, it's the structure. The diversification between their insurance platform, United Healthcare, and their services platform, Optum.
And they're not just separate businesses. They feed each other, right?
They feed each other. Optum is like a data machine. It does everything from pharmacy benefits, the PBM side, to clinical services, and crucially, predictive analytics.
So they're using the data from Optum to help United Healthcare.
Exactly. The key insight is that Optum's deep understanding of medical costs and patient data lets United Healthcare price risk way more accurately than their peers.
So what's a cost center for everyone else, medical claims, is an information asset for them.
You've got it. That solidifies their competitive edge, and they back it up with quality, which is critical for keeping customers, especially in government programs.
Right, the star ratings.
The star ratings.
Right.
They have 78% of their members in 4+ star Medicare plans, which is just a little bit above the industry average. That quality helps with loyalty, with retention, and it makes it incredibly difficult for smaller players to even try to catch up.
Okay, let's shift to what's next. This is where it gets really interesting for anyone watching the stock. What are the known catalysts over the next 3 months, say through January 2026, that could move the price?
The immediate focus is going to be the Q4 earnings release. That's expected in late January 2026.
And everyone will be watching the margins.
Everyone will be scrutinizing the managed care margins and cost trends. Winter usually sees higher healthcare use. If they show they controlled costs well in Q4, the stock could react very positively.
And then there are the market-driven events that show us where the big money is moving.
Yep. You'll want to watch the index rebalancing, like the MSCI on November 22nd. But more importantly, you get the 13F filings on January 14th.
Right. For anyone new to this, the 13F is where the big funds have to show their hands.
It is. It reveals exactly what the major hedge funds and asset managers have been buying or selling. It'll tell us if that conviction we saw from Appaloosa has started to spread.
And what does the technical picture look like right now in mid-November?
It confirms the bullish story. You have a strong trend forming. The stock successfully defended that key support zone between 332 and 343.
And now it's testing resistance.
Now it's pushing up against resistance between 350 and 360. But here's the critical part. The beta is only 0.43.
So it's still volatility. It isn't getting tossed around by the broader market.
Exactly. It's moving on its own story. It suggests steady, large-scale institutional buying, not, risky speculation.
Okay, so beyond those set dates, what about the big speculative rumors, the things that could really unlock more value if they happen?
The biggest piece of market chatter is about a potential DOJ settlement soon.
For the Medicare billing investigation?
Yes. If they can remove that regulatory shadow, it would clear the air completely. The market could finally just focus on the fundamentals, and that would likely cause a major re-rating of the stock.
That would be huge. What else is being whispered about?
There are persistent rumors about major premium hikes for 2026.
Which would be the most direct way to fight back against rising medical costs.
It would. But it also carries, significant public and political risk. You can't just hike premiums without expecting some backlash.
Of course.
And finally, there's always talk of more acquisitions, bolt-on deals in digital health or the PBM space. With $16 billion in cash flow, that's always on the table.
So you've got this strong foundation, you have institutional backing, you have a list of potential catalysts. It's no wonder the analyst consensus is so bullish, with some targets up near $521.
That's right. That target reflects a belief that the company's sheer scale gives them the tools, both operationally and financially, to handle these external pressures and capitalize on the huge demographic tailwind of an aging population.
Okay, we've laid out the strengths and the upside pretty clearly. Let's be balanced.
Yep.
What are the specific risks you have to be watching? What could derail this whole story?
The biggest risks are systemic. Nobody is seriously threatening their market share. The real challenge is managing their own internal pressures and that external oversight.
So risk number one is still medical cost inflation.
It has to be. That's what squeezed their margins in 2025. People just used more healthcare than anyone projected. Management has to prove they can get ahead of that, either through repricing or finding more efficiencies in Optum.
It's the constant balancing act for the whole sector.
It is. And risk number two is, of course, the regulatory overhang, the DOJ investigations, the constant threat of new rules in a very politically charged sector. That's always going to be there.
So if we boil all this down, the turnaround seems real, the fundamentals are stellar, and the big money is on board. What's the final verdict?
The outlook is still extremely bullish, probably a 9 out of 10. That confidence is really driven by the expectation of margin recovery and that clear institutional alignment.
But with a big F.
But it hinges entirely on execution. They have to successfully control those costs, and crucially, they need to resolve those lingering regulatory issues. If they can't, the recent gains could disappear pretty quickly.
That's the takeaway then. Strong foundation, a lot of support, but you have to keep your eyes glued to that cost data and any regulatory news.
Which leaves a really interesting question for you, the listener, to think about. If United Health successfully uses its massive scale to push through aggressive premium hikes in 2026 to fight those rising costs, does that inherent tension, the one between maximizing shareholder returns and facing public and political anger, does that become the ultimate ceiling on their growth? Or is the opportunity in U.S. healthcare just too enormous to be held back by politics?